Debbie Haverly, CPA and founder of Income Tax Assist, and I'm here today to talk about the tax consequences of a short sale and to offer to you and your clients a 1-hour complimentary meeting to discuss the possible tax consequences of their short sales. First of all, let's talk about some terminology. COD, cancellation of debt. When the mortgage is forgiven by the bank, or part of the mortgage is forgiven by the bank, that is considered cancellation of debt, and it is considered taxable income. The bank will issue a 1099-C to anyone who has cancellation of debt. They'll issue it in January of next year, and a copy will go to the IRS. There's many ways we can exclude that cancellation of debt from taxable income. And that's where your client needs to get in front of a good CPA or someone very knowledgeable about cancellation of debt. Is this their primary residence? Is this the original purchase money loan on their property? Did they refinance? When they refinanced, did they take any money out? Did they use that money for improvements? These are all questions we're going to need answered to be able to determine if any or part of this money is taxable to them. If none of these exclusions work, we will look at your client for insolvency. Insolvency means that they had more debt than they did assets on the day before the short sale. So we'll need information about all of their assets and debt at that time to see if they qualify for the insolvency exclusion. Also, what if you have investment property? What if this is a business that owns its own real estate? Or what if this is an investor that has many rentals? There are also exclusions possible for business real property debt that has been forgiven. All of these come together and we can exclude many of these cancellations of debt from people's taxable income. It's probably best if they come in and meet with us before they go into the transaction so we can let them know where they stand so that they go into the transaction fully aware if they're going to have a taxable event or not. So here's some items that your clients should keep or bring to the meeting, but definitely keep for their tax return. Their last mortgage statement that they made their last payment on so we know what their mortgage balance was. The last property tax statement that they paid. Their settlement statement when they purchased the house. A detailed listing of any improvements made to the property while they owned it, and then of course their settlement statement when they went through the short sale. We will need all of these to determine how the money flows on their tax return. Something to watch out for is you want to make sure that if the person has a second on that property, that second is forgiven as part of the short sale. We don't want that second to turn into a personal loan where they're still liable for that loan after the property's gone. And another nice thing, if it's possible, is to have the debt forgiven on the second in the same year as the short sale. That way we can wrap it all up on one tax return. If we can't get that accomplished, then at least have all the information so that we can report the second on that tax return. And then in the future, when it is forgiven, we can point back to this year's tax return and say, we've already reported that. So what I would like to offer you is a 1-hour complimentary meeting for your clients to come sit down and talk about the possible short sale transaction and see if it's going to be a taxable event for them before they enter into the transaction. I'm Debbie Haverly of Income Tax Assist, where your bottom line is our top priority.